Hey, good morning, everybody. It's Hammer. Today is Thursday, August 8th, 2024. Of course, from the Originator Success here with the Daily Mortgage Rate Update, the only place on the web where you guys get to join me live on Facebook and on YouTube each and every weekday morning, 9:30 a.m. Eastern Time, coming to talk about what's going on with rates and pricing. Not good news today, my friends. Not good news. Seeing an overcorrection to the overreaction. We'll go deeper and talk about that in a minute. If you're here live, say good morning. If you're watching on the replay, go ahead and give me a hashtag replay. Let me know that you were here in the comments. Don't forget to smash that like button, tag a fellow friend, share us in a group. Remember, if you'd like to sign up for our free email lock advice, I send that out each and every weekday morning, www.ratelockadvice.com. You can also sign up for our text alerts if you want to be aware of what's going on. We've seen a lot of volatility. If you want to protect your pipeline, check us out, originators or ratetextalerts.com. You can sign up for a reminder for the show. If you'd like to be reminded, this is absolutely free. If you want to be reminded that I'm going live so that you can hop on, you can sign up at hmmr.io/reminder. And last but not least, check us out at originatorssuccess.com. Find out how we help you get loans from Google and social media, how we'll help you take advantage the next time rates drop so that you can actually pick up some loans out of all that. Check us out at originatorssuccess.com. Find out more about that. So with all of that out of the way, let's go ahead and say hi to the live folks. Then we'll jump in and talk about what's going on this morning. So if you're here this morning, say good morning. We got Mr. James Mahan here. Good morning, sir. Philip Zaller, good morning. With Flex back at you, my friend. We got Mark Clark. Good morning. Amy Blauser. Great to have you here as well. Sean said, nice, I didn't block you. Dude, I feel young. You're probably around the same age I am. You probably have this in your mind too, right? I feel like I'm 22 years old in my brain. My body feels like I'm 82 years old. I wake up and, all the things I've broken and torn, but I get you, man. I wouldn't block you for saying I'm old. Monica Dinkins, good morning. Benoit Babu, good morning, sir. Deb Dickinson, great to have you here as well. If you're here, say good morning. Otherwise, let's go ahead and keep going, talk about what we got going on today. So rate sheets this morning, taking another beating. Guys, I was hoping yesterday we were going to see things level out, but what we're seeing now is an overreaction to the overreaction. So it's an overcorrection to the overreaction. And jobless claims this morning came in not even really all that high. Let me go ahead and let's go over to the shared screen and let me share my screen. We'll talk about it. But this morning you have bonds taking a beating because of a strong reaction. Let me just move this out of the way to the it's an overreaction to the jobless claims, so we just go from one overreaction to the other. So rate sheets taking a beating this morning. The number of new filings for unemployment. So jobless claims is a fancy term for unemployment, right? Unemployment insurance. When somebody's putting in for unemployment, well, number of applications fell more than expected last week, suggesting fears the labor market is unraveling. We're overblown. Gee, who else has said that? And the gradual softening in the labor market remains intact. Initial claims for state unemployment benefits fell 17,000. Again, everything is seasonally adjusted. I don't know why we have to have seasonally adjusted. I wish they would just give us regular numbers. I think seasonal adjustments mess things up more than anything. For 233,000 for the week ending August 3rd, and it's the largest drop in about 11 months. They had forecast 240,000. So it's fell by 17,000. So it would have been a 250. That's their numbers off. That's only, it came in lower than expected. And yet we saw a very clear reaction. Take a look here with this morning. Let me go ahead and put this on a 2-day and let me adjust this a little bit so we can bring this up, right? So take a look here. You can see, look at this line. Look at it, 8:30 a.m. Boom. We were up on the day. Bonds were looking good. I'm like, okay, yesterday we saw things settle in. It was improving. I had my fingers crossed, right? But then boom, jobless claim data came out and look at this reaction. It's just ridiculous. Way over reaction to, basically the jobs data comes out every week. Ron said they seasonally adjust because there's so much better understanding the numbers than we, the people. Yeah, all right, my friend. So anyway, rate sheets are taking another beating this morning. They're going to continue to get worse. Reprice risk on the day, though, is low. It's not likely that we see a big sell-off from this. Right now, mortgage-backed securities down 16 basis points. 16 to 20, but I don't think we're gonna have to worry about seeing any big sell-off. But take a look at this. If we hit this for a 5-day chart, look at how this was Friday, right? So Friday we saw the big spike with the unemployment data, or with the BLS jobs data rather, unemployment going up, all that stuff. Things improved on the day. Monday, we opened because markets, remember, stock market crashed, Japan, just so many different variables here. Huge increase in mortgage bonds for the morning. But when the US markets opened, we lost that ground very quickly. Look at the spike. And then we just really continued to move down on Monday. Let's take a look here and see what that looks like on the Japanese candlestick. So right here, this was Friday's candlestick. The reaction to the jobs data, you could see it came all the way up. Look at this wick. Remember, the wick, this little thin line, this is the point at how high bonds were trading, and then the body, the thick part, is where they actually ended the day. So they were trading as high as this. We saw very, very strong reaction, but markets tended to give that back. Then on Monday, we opened very high. So when you have a red candlestick, the top is the open, the bottom is the close, because that's why it's red, as we lost ground. When it's green, we know we started down here and improved on the day. Red, we started up here and got worse on the day. And that's what that looks like here on that spike. And since then, look at this. On Monday afternoon, Tuesday, we lost ground. Wednesday, we lost ground. Today, it looked like we were getting some recovery on that and that we were going to get a bounce. And then the jobless data comes out and we lose more ground again. I think that it's still going to hold, but that's not where we want it to be. This is obviously not what we want to see. So the outlook is rates could keep creeping up a little bit from here. I mean, we've seen this. Taking a look here. Oh, I didn't want Wall Street Journal. Let me pull up Mortgage News Daily. There you go. I mean, 6.58. That's still better than where we were before the Fed meeting, right? So we were high sixes, very close to 7 before the Fed meeting. Now we're down into the mid, 6.5, 6 and 3/4, 6 and 5/8. We're in there, right? We see all this stuff happening here, and we could see them creep up a little bit. Now, there's nothing going on tomorrow. Tomorrow should be a quiet day. There's no economic data. Today, there's 30-year Treasury auction is the only thing on the board. Yesterday's 10-year Treasury auction was weak, but it wasn't really anything terrible. I mean, that was at 1 p.m. So when you look at where bonds were at 1 p.m. at 100.40, and they went down to 100.39, and then they're back to 100.40 by the end of the day. So you could see not really likely to have a big reaction. Next week, we've got more data. We've got CPI inflation data, but that's not going to be any big savior. Now, again, I had warned, and in fact, somebody, I took a screenshot of it because somebody on Facebook said about people forecasting. This was the commentary from Friday, right, that I put out. The outlook is good for rates. However, I'm concerned that markets have gone too far in speculating the Fed will have to make much deeper cuts this year than what was being forecast just a couple of days ago. This would mean we'd be seeing some of the best pricing rates now, and we'll see a pause and some pullback before they can make a big move lower again. That was what I had put out there on Friday. And that's, exactly what we've seen happen. On Friday the 2nd, we had, our best pricing here. Actually, of course, on Monday, we even got a little bit better pricing on the day. And then it worsened and worsened. And we've seen that pullback. And that's not a huge pullback. It feels huge, but we've pulled back 1/4 to 3/8 of a point. But when you're quoting, that's a big deal. I get it. But in the scheme of things, when we're looking at the markets, it's really not. So again, where does that put us from here? We're seeing an overcorrection. Definitely want to keep a focus here on what's going on with the expectation of Fed rate cuts. We're seeing this seesaw move in the other direction. You are seeing that the expectation of a 50 basis point rate cut is dropping. Let's go ahead and put this on compare and see. Yesterday it was still at 70%. It was actually higher than that. It doesn't show on the chart because it only goes to a week ago. And a week ago, look at where we were pre-Fed meeting. Pre-Fed meeting, we were at a 22% expectation that we could see a 0.5 point rate cut. Then after the Fed meeting, it went all the way up to 80%. Now it's down to about 55%. Same thing here. A month ago, the expectation of a 1/4 point cut was 70%. Then it went to 78%. Then it dropped now to 31% and up to 43%. So we're seeing a growing expectation that we're only going to get a 1/4 point cut. The inflation data on the 14th here are going to be a big, important one. expect the next labor market, BLS labor data, jobs data on September 6th is going to be a big deal. And then, of course, September 11th, they get the CPI data again there. So all of that going on. As far as expectation for where we'll end at the end of the year, right now, you could see that we're at 5.25. So 3/4 points, only 27%. Biggest expectation is a full point. That's much higher than it was before. Let's see if it shows if we do the compare here. Look at this. This was a huge expectation a week ago that we would be at 4.5. Then, now it's an expectation that we'll be at 4.25. I think we're going to go back to expectations of being at 4.5. That's 3/4 point rate cuts. In my opinion, still the most likely to happen. So good morning, Jay Rodriguez on YouTube, my friend. Good to see you there. Ron Siegel pointing out a couple of different things. Let me pull up the chat and we'll talk about that real quick. He said, light vehicle sales previously enjoyed double-digit growth, now experiencing declines. Yeah, I mean, it's obvious that people are spending less money. Whether we call it a recession or not and which parameters we use for that, I don't think it really matters. We need people to be spending less money. And again, we've talked about the fact that the money they're spending is coming from credit. So that's going to slow down and run out. But Ron is pointing out that the economy is certainly not running like a freight train. But is it so weak, Ron? And is the unemployment data so bad that the Fed needs to go ahead and needs to get rid of those? No, I don't think it does. Hold on a minute. Let me find. I have to go back. Every time I change these, they call them scenes now. You can have different things up there. There we go. So, I mean, when it comes to lock advice, y'all, I'm going to keep it where it was. No, not this. That wasn't it. It's this one. Here you go. Anything less than 15 days, I've been saying to lock because we are seeing continued volatility and see rates creeping worse. Anything is closing 15 to 30. I've been saying that if it's risk averse or you like it, lock it. And at this point, we're getting close to where we've given back enough of the gains that I would probably lean more towards floating again. I don't think the CPI data next week is going to be earth-shatteringly good. I don't think it's going to show inflation has dropped tremendously. I don't think, even if it comes in as expected, it's going to give us a little bit of help, but we're at that kind of that lull in rates again. The big thing to remember is, having everybody that's on your list, your database, your past clients, anybody that's looking, talking to them about when we see these steps down in rate, when do they want, how urgent is it to do, to take action and get a loan? If you're buying a house, you wouldn't not put in an offer because rates have crept up, right? But if you're refinancing, you want to make sure you're setting those parameters. I've got some scripting and stuff. I'm going to be doing some webinars for 2020 Vision for Success through September, October, November, December. I'll see if Christine and Jason Frazier will allow me to share those out in the public to get some more people on. I'll be going over scripts and role playing and talking about this. I know many of you could use a little polish on the conversation and what that looks like. So we'll do some more with that. But also got an event in November. I will be with Consolidated Coaching in Austin, Texas. I'll be talking more about that soon. And in December, I'll be in Arizona for 2020 Vision for Success. So, all right, my friends, that's all we got today. Again, I think reprice risk on the day is low. We've seen some losses early. Rate sheet's taking another bit of a beating this morning. I don't think it's going to get much worse from here, and I don't think it'll get much worse tomorrow. But do remember, we have seen a very consistent downward trend. Oh, one thing I should be pointing out too, by the way, let me pull this back up here. One thing that I should be pointing out is 10-year Treasury yield. It was at 4.01 a minute ago. Now it's at 3.997. So that's 4%. You could see, look at this spike. We'll actually do a 3 months because then you can really see it. Look at this spike. We saw this huge drop down, open on Monday at the lowest level, and have just seen it kind of creeping up. We should see that end soon. So Rodriguez is going to be in Austin. Awesome. Definitely. Are you going to be at the Consolidated Coaching event? That's, I'm assuming. So that'll be awesome to see you there, my friend. So, all right, everybody, I will catch y'all later. If you have any questions, let me know. Otherwise, appreciate you guys joining me every day, and I'll see you tomorrow. Bye-bye.